Hello and welcome to Policy Watch. In the next half an hour, we discuss in depth the top economic developments of the week. Before we go any further, here's a quick look at the top headlines. The RBI keeps policy rates steady, no cut in either repo or CRR. Governor Subbarao chooses to wait and watch. India Inc. up in arms. The G20 summit concludes in Los Cabos. World leaders pledge austerity measures. Prime Minister Manmohan Singh outlines India's immediate goals. The rupee tumbles again, even as the RBI intervenes mildly, touches a record low of 57 against the dollar. And Purno A. Sangma is the BJP's choice to run against Pranab Mukherjee in the presidential polls. The former Speaker of the Lok Sabha quits the Nationalist Congress Party in order to contest the election. Those are the headlines, and now it's time to introduce my guest this week. I welcome back to the studio Pinaki Chakrabarti of the NIPFP. Welcome back to the show, sir. Great to have you back. Before we jump into our first story, let's see what we have filed for you. The first story. Defying industry and market expectations, the Reserve Bank of India on Monday chose to keep policy rates steady and avoided any change in the main repo rate as well as the cash reserve ratio or CRR. As a result, the repo rate stays unchanged at 8%, while CRR will continue to be at 4.75%. Here's a report. Take a look.
Citing increasing inflationary pressure as an important factor in its decision to keep key interest rates as well as the CRR unchanged, the central bank reiterated that it would continue to keep an eagle eye on inflation before any further easing of policy rates. Shooting down industries' oft-repeated claim that growth in the country had slowed down as a result of high interest rates, Governor Subbarao said that according to the RBI assessment of the situation, high interest rates had just a small part to play in the growth inflation dynamics, with the majority of the blame resting on a decline in investments. External economic has also had a major impact in India's growth, hitting the brakes according to the RBI. Another important declaration coming from the RBI was that the government needed to step up efforts towards fiscal consolidation. Governor Subbarao reiterated that the central bank had front-loaded policy rate reduction by 50 basis points in April with the view that it would kick-start the consolidation process as well as supply-side initiatives. The government on its part stood by the RBI decision with the Finance Minister Pranab Mukherjee saying that the RBI did not need to consult the government with its mid-quarter policy review.
Policy announcements, and they have retained the all crucial rates including CRR, repo rate, reverse repo rate as it was. Perhaps the inflation figures, WPI inflation which is in the month of May, which was 7.56, little more than 7.33, and there has been some marginal increase in CPI also.
The RBI has warned that a further reduction in rates at this juncture, rather than supporting growth, could exacerbate inflationary pressures.
Industrial data in April has suggested that there is no great hope that the economy will pick up soon. And to make matters worse, the government has been hampered by its political compulsions, hence unable to derive reforms. A worsening fiscal deficit also limits the government's ability to propel growth and provide stimulus. The focus now shifts to the next RBI meeting in July, which the RBI watchers expect will probably be more decisive than the last one. Bureau Report, Rajya Sabha Television.
There you go. So, before the meeting on Monday, there were expectations of a rate cut, perhaps if not a larger cut like last time when they delivered one in April, about 50 basis points, but perhaps at least a 25 basis point cut in the repo. Didn't really happen. Were you surprised, or were you also expecting them to keep it steady?
No, I was surprised, and I thought the rate cut would be more than 50 basis points.
This time around also.
Yeah, so I was really surprised, and I really do not have an answer why they did not have a rate cut, because I think given the fact that fiscal deficit is high and that is a problem, if you continue to increase the policy rate, that is only going to hurt growth. So I was expecting that there will be a rate cut which would boost investment and in turn growth, but that did not happen.
There are, of course, the different rationales being bandied about, saying that because they delivered a big rate cut last time, this time around the rationale being, look, we delivered one last time around, more than expected. So this time we'll wait and watch and see where the inflation growth dynamic takes us. Do you think that's the right rationale, given the fact that Governor Subbarao is under a lot of pressure?
No, I don't think so, because if you look at the increase in the policy rate, that has happened in a very quick succession for 13 times. So you started reversing that rate card only in April. And inflation, of course, it's still in an uncomfortable region. But if inflation is the prime reason of the RBI's monetary operation, which should not be the case in the sense that the complex operation of monetary policy in a developing country of India cannot be only inflation control. And the fact that your growth is faltering, your investment has come to a standstill, in fact, going negative in some sectors, it is critically important that you give a signal, well, I am going to reduce the cost, go and invest. Now, if you don't do that, and if you say that I have increased 13 times policy rates and I have reduced one time the policy rate, so that you should wait more, I think we are actually not doing the right things. And also the fact is, if you have a high policy rate, that would have an across the board increase in the interest rate. And if you don't reduce it further, and if you look at the inflation, I understand inflation is high, but the real rate of interest is pretty high. So the kind of rationale that RBI is giving, that saying that when we had a very high growth, like 2003-4 to 2007-8, our real rate of interest was higher than what it is now. So interest rate is not the reason for the faltering of growth. See, we cannot compare 2003-4 and 2009-10 with 2012.
Completely
different scenarios. And we are comparing a situation where you had a very high savings rate during the earlier phase.
But some would say the savings rate right now is not that bad either, around the mid-30s.
But if you compare in relative terms,
it's obviously
during
gone
that
down.
period, the saving is coming down. So there is already a pressure on interest rate, your fiscal deficit is high, and now your sole concern is inflation control, then definitely you are going to hurt growth.
Immediately after there was an announcement, the news spread that they hadn't tinkered with any of the rates and they would wait and watch. Industry started screaming bloody murder. In fact, one of the main chambers of commerce of the country, a high-ranking official from there came on the show and he said this would not only slow down growth further, it had the potential of sounding the death knell to kill growth off if they continue to have this inflation-centric policy. Do you agree with industry leaders there saying that?
I definitely agree with the fact that central bank of a developing country like India cannot have a single objective of inflation targeting or inflation control.
And some would say it hasn't even worked.
It hasn't. It hasn't. In the process, you actually have created difficult atmosphere for growth. So all the time we blame fiscal deficit, high fiscal deficit for low growth. But I think monetary policy has played its own role to kill India's growth story. So to that extent, I'll definitely agree with the fact that RBI has been following textbook macroeconomics to control inflation, which are written in the context of developed countries, has very little relevance in a complex developing countries macroeconomy like India.
So you're saying a textbook approach will not work when the situation is not textbook?
Absolutely. Because this time around, they should have gone for a rate card because some of the structural factors which affects inflation have eased out. One is steady decline in the crude prices. So that would definitely have a positive impact on your inflation pressure. Secondly, if we look at the supply side management issues, definitely there are constraints. But at the same time, you have to see to the fact that the food grain production has been good, and definitely we have to ensure that things come to the market so that prices of the basic essentials, food prices don't go up. Now, controlling inflation cannot happen only by targeting the policy rates, because there are a lot of structural issues involved in inflation, and those structural issues will have to be addressed. I think those issues can only be addressed through the fiscal side, not through the monetary side, given a country which has got large section of people who have no access to the formal financial market. So the effect of this interest rate increase or keeping it at a level which is uncomfortable is definitely going to hurt growth.
In the rationale, in the statement that came out that day, Governor Subbarao also mentioned that he doesn't believe, like you mentioned before, he gave the reason that the reason why growth is slowing down is because investments have fallen. But isn't, and he said high interest rates are not so much to blame, they're partly to blame, but not the main drivers of it. But aren't the two intrinsically interlinked? If you have a high interest rate, wouldn't investment automatically go down?
What is the cost of fund? Cost of fund is your investment. You have a global uncertainty. You have uncertainties with regard to your domestic demands because the income is falling, because your growth is falling. On top of that, if you make investment costlier, what is going to happen? It's going to hurt your growth. So now you really in a situation which is so difficult because of the global uncertainties, domestic uncertainties, high fiscal deficit, if you continue to increase interest rate, that is the cost of fund which you are going to invest, definitely that is going to hurt growth.
One last question, sir, on this particular subject. First of all, it's a double header, very briefly if you could. First of all, isn't the government also equally to blame, because the current account deficit and the fiscal deficit obviously are both out of control, and they're also affecting our growth as well. Shouldn't industry also be blaming the government for its lack of austerity measures or what have you, rather than just blaming the RBI?
No, that is true that we have a very high fiscal deficit, but this fiscal deficit will have to be understood in a context. That context is that you had a global financial crisis in 2008. That time you have given a lot of fiscal stimulus that increased your growth. At the same time, that has also resulted in an increase in deficit. Now, we have not been able to control that deficit because growth is falling, your revenues are falling, and also you have a lot of populist program that is going on. Subsidies are going high because of the high increase in the crude prices in the last couple of years. So naturally, fiscal deficit is definitely high. But if we look at the aggregate fiscal deficit, taking center and states together, states' fiscal deficit is well below the fiscal responsibility target. So it's the center's fiscal deficit which has to be blamed. So in such a situation, definitely fiscal side is a problem. We need to bring it to the level which is comfortable to the industry.
Professor, do you see a rate cut happening in the next meeting of the RBI?
I think that should happen. Whether that will happen or not, I don't know. But I think that should happen. A lot of people are definitely talking about it, that it might happen in the next, in July, rate cut. And if that happens, I think that would be good for the industry.
Expectations rife, of course. So we'll take a small break right now. We'll come back with the next story. Don't go anywhere. We'll have more with Pinaki Chakravarti after the short break. We'll be right back. Hello, welcome back. You're still watching Policy Watch. Now, leaders of the G20 group of countries met in the resort of Los Cabos in Mexico in the backdrop of a worsening Eurozone crisis. The leaders called for collective action to deal with financial market tensions and promote trade, growth and jobs. Our bureau filed this report. Take a look.
Committing to fight economic slowdown and combat corruption, the G20 leaders have expressed confidence that the $450 billion firepower of the International Monetary Fund would help in safeguarding financial stability and preventing global crisis. Indian Prime Minister Manmohan Singh also attended the summit, where he held bilateral with various leaders, including French President François Hollande, British Prime Minister David Cameron, German Chancellor Angela Merkel, and United States President Barack Obama. The attending leaders also expressed deep concerns about rising instances of protectionism and expressed their commitment for open trade and investment, expanding markets and resisting protectionism. On reforms of the IMF, the G20 leaders agreed to complete the comprehensive review of the quota formula to address the deficiencies and weaknesses in the current quota formula by January 2013 and to complete the next general review of the quotas by January. Bureau Report, Rajya Sabha TV.
There you go, sir. Now, the G20 leaders have expressed confidence that the so-called $450 billion firepower that they'd provide the IMF will effectively deal with to combat the global slowdown. Do you think throwing more money at an institution which many consider to be ineffective and also a cause of many an economic imbalance is the right way to combat economic slowdown globally?
Well, I don't think we have any other choice, because the global financial institutions where we put money to combat global crisis is definitely IMF. So I don't think we have an alternative choice whether we go for IMF or otherwise. IMF's performance is a different question. It's altogether a different debate.
Right.
I think what is more important is how this fund will be utilized. What are the conditions that IMF will put when they give money to specific countries which are suffering. So, and if this actually helps in terms of providing stimulus for investment, export, trade, definitely that would have a positive impact. But if these funds are also heavily loaded with conditionalities, which definitely means austerity measures, and I'm not saying that you cannot have an austerity. Austerity is important, but as you know, even in the Greece, after the New Democratic Party came in, they are renegotiating on the austerity measures.
Right.
They are not against austerity, but they are saying some of the provisions of austerity are really are going to hurt common people of the country. So in such a situation, I think there is a trade-off between austerity and the bailouts. So how that money is going to be used in terms of specific policies, also a specific sustainable path of fiscal and current account deficit, that would be the important thing to see.
It's interesting you mentioned Greece and, of course, austerity as well. Pro-bailout parties have won the election in Greece, very narrowly, no doubt. But there will be a coalition there soon as well. What do you think the message went from the G20 summit to the leaders of the new coalition there, the pro-bailout parties there, and also to the leaders of the nations of the Euro, which are struggling right now? What would have the message been from the G20 leaders to those people?
I think we have to understand the Greece election result in the context of whether they would remain within the Eurozone or will go out of the Eurozone. I think majority opinion was that they should stay. I think that is why they have won. But I think there is near unanimity in Greece in terms of the provisions of austerity. I think there is almost even among the New Democratic Party, they are talking about that we will renegotiate on austerity. I think what is important to see here is to what extent these negotiations will happen. Of course, there is a big problem of debt. Of course, there is a big problem of deficit. Of course, there are huge macroeconomic imbalances which needs to be corrected. But at the same time, you have to ensure that it doesn't result in loss of job. It doesn't result in provision of basic services like healthcare, education, and social security. So with all of those in, how this is going to have an impact on growth is something which has to be seen. And I think pro-austerity measure is the signal that the G20 also has given. Because most of the G20 partners are pro-austerity, including India, whether you are able to practice it or not.
Right. Close to home, sir. Prime Minister Manmohan Singh was there. He made a passionate speech there as well, outlining his goal. And I'm quoting 2 lines from his speech now. My overall assessment, he says, of the meeting is that there was general agreement on that policy in all countries must shift to strengthening growth. There was also general agreement that most urgent problem we must tackle is to reduce uncertainty about the Eurozone. But back home, efforts to that end, strengthening growth, haven't really worked, have they? The situation back home looks quite grim. If you look at the core sector results, the IIP numbers are down. Is this a leader of a country at a world stage positive posturing, or is there more to it than that?
No, I think the turmoil in growth, India will have to see seen in 2 periods, 2 parts rather. I think India was very complacent after 2007-8 to 2009-10, even first part of 10-11, that we are growing much better than others. But that story now, from the last 6 months, nobody is buying. Because everybody is talking about, no, actually you are slowing down. That process has started from 2007-8, being seen now. So I think it is very important to strengthen growth, but at the same time, that cannot happen automatically, because that was the posture that the government had, that it is going to happen automatically. It is not happening because you are having a tight monetary policy. At the same time, you are having a huge fiscal expansion, which is not actually resulting in growth promoting government expenditures, mostly current expenditure driven. So in such a situation, I don't see, unless corrective policy steps are taken, like reforms in GST. I think it's one of the critical reforms which can really push growth, but that is not going to happen soon. So I really do not know whether we can automatically have a high growth in the next fiscal year.
On that point, it's very interesting you mentioned GST as well. That's a very pertinent point, I must say. On that note, we'll take another small break. We'll come back and discuss our third story of the week. More with Pinaki Chakravarti on the other side of this break. Stay tuned. Welcome back. Now, the rupee fell to a record low against the dollar on Thursday and followed up with another all-time low of 57 against the dollar on Friday to approach the psychological 57 mark, hurt by dollar demand from oil firms and gold importers, as well as the broad risk-off sentiment. The RBI was suspected to have sold dollars on Thursday, though the actions were described by traders as mild. The partially convertible rupee hit a record low of 57, down nearly 1.2% from its Thursday's close of 56.30. Now, so for a long time, we've been hearing that some amount of depreciation for the rupee is sort of not that bad for the economy. But now we've seen for the past couple of months, the rupee fall has been constant and it's been quite worrying. Don't you think we should be worried now the rupee is falling so much?
Yeah, it is a matter of serious concern because you have huge chunk of inelastic import, which doesn't depend on the price of the dollar. It has to be imported like oil. So in case of price inelastic import, if the rupee actually falls, you end up paying more. So naturally, that is going to further aggravate your current account deficit.
So traders have said recently in last year, 2 days especially, that the RBI intervention when they started selling dollars, they were so strongly suspected of selling dollars, was slightly mild. Do you think the RBI should be more proactive in intervening in the forex markets, or do you think they're doing all they can?
I think RBI has been managing exchange rate in the last couple of years reasonably well. I think it is not that RBI intervention has gone bad, that's why the rupee has crashed. I think the crashing of rupee has to be seen in the context of global turmoil in the Eurozone, as well as the reflection of the domestic economy, because your growth is faltering and confidence is on the decline. So naturally, which cannot be just controlled by RBI intervention. So I think it's a larger macro problem, and I don't see this is being arrested in the near future. I think rupee is continuing to slide even further if this is the situation that goes on.
That was going to be my next question. Some analysts have said that it will touch the 58 mark pretty soon in the next 2 months. What's your assessment of the situation?
I think it is going to happen, but one possibility that it might not happen so fast if the crude remains, at a level, if the crude prices come down and things like that happen, and it also would depend on the kind of capital flows that we are going to get in the next 2 months.
And crude prices have eased in the past month.
Substantially.
And do you see them easing further?
I think so. It might ease even further. So because today it is less than $90 per barrel. So if it eases further, that is the point which I was trying to make in the beginning of the show, that this was the high time to reduce the interest rate.
Right,
so you know that would have given a good signal to the investment climate, and probably the rupee would not have fallen this much because I think we have a problem of policy confusion.
Right.
So I would not say the policy paralysis, but there is a confusion signal that is going on.
There's some problem. There is no unanimity in the discourse, economic discourse of the country is what you're saying.
Absolutely.
At that point, sir, we'll have to end the program. Thank you so much again for joining us on Policy Watch. That was Pinaki Chakravarti from the NIPFP, of course, saying that the RBI probably missed an opportunity to propel growth by not cutting rates this time around. Perhaps it was the right time to cut interest rates, ease them further. But let's wait and watch. There is another meeting happening in just a couple of months' time as well. Perhaps the RBI will take some action. Then, on our second story, the G20 summit, of course, concluding in Los Cabos, Prime Minister Manmohan Singh outlining India's vision and immediate goals. He's very optimistic that a growth rate of 8 to 9% will be achieved, and he wants to keep the fiscal deficit to 5.1% of the GDP. We'll have to wait and watch whether that happens or not. Also, Pinaki Chakravarti seems to think that the IMF is really, we don't have much choice but to actually strengthen the hands of the IMF in controlling and combating the global slowdown. As far as the rupee is concerned, most analysts, including my guests, think that it might just fall a little further. Of course, we'll have to see whether or not crude prices ease further or not. That's all the time we have from Policy Watch this week. Till next time, thank you and goodbye.